Hello everyone and welcome back to the channel for the last part of how to invest in stocks for beginners. We will talk about tax implications in investing, retirement accounts, tax harvesting, Warren Buffett's principle in stocks, due diligence, and more. So be sure to watch the entire video to learn more about investing. Now, let's discuss the tax implications of investing, especially what occurs when you sell a stock. Everything in this part applies to these taxable standard accounts. So you will be taxed whenever you sell a stock or any capital asset for more than what you paid, since this results in capital gains. This is why before selling a stock, you should think about how much tax you'll have to pay. This is significant since we have two types of capital gains: long-term capital gains and short-term capital gains. I highly advise long-term investment because it allows you to take advantage of long-term capital gain rates, which are often significantly lower. So if you sold a stock after at least 1 year of holding, you'll be able to pay lower long-term capital gains taxes, which will be 0%, 15%, or 20% depending of course on your income level. So if you look at this table here, it will give you your long-term capital gains rates based on your income. So if you're single and earn between $0 and $41,675 per year, you'll pay no taxes on your long-term capital gains, which is incredible. This increases to 15% if you earn up to $459,750 or 20% if you earn more than $459,751. Now, short-term capital gains, on the other hand, apply if you sell your stock that you've owned for less than 1 year and are taxed as ordinary income, which ranges from 10 to 37% depending on your income level. So generally speaking, holding for more than a year will result in significantly lower taxes. You might be wondering how you can tell how much money you've made purchasing and selling stocks in a particular year. Fortunately for us, your brokerage will provide you a tax document including your capital gains or losses every year. Therefore, if your goal is to invest and pay the least amount of taxes necessary, holding for more than a year will have a major influence on your profitability with investing, particularly if you are in a higher tax group. And now, let's discuss retirement accounts and how they may help you save money on taxes. As previously said, I strongly advise taking advantage of tax advantage retirement accounts, such as the Roth IRA, which we will discuss presently. You will be paying taxes on the money you make today if you use the Roth IRA, placing that money into an investing account and allowing it to grow so that when you retire, you pay no taxes on the profits. This is the ideal option if you believe that your marginal taxes will be greater in retirement than they are now, which, let's be honest, is definitely the case. Consider it. With a Roth IRA, you only pay taxes on the money one time, but with a taxable account, you pay the taxes twice. First, on the money you're making, and then again when you see capital gains. This is why I believe it's so great and why I assume anyone who can qualify for a Roth IRA should definitely open one. I've already said that you can put in up to $6,000 per year or $7,000 if you're over 50. You can't make more than a certain amount of money to get a Roth IRA, but if you do, you can do something called a backdoor Roth. If you are a high earner, I recommend this. Apart from the Roth IRA, there are also various types of retirement accounts, like the Standard IRA, 401k, and SEP. Now, let's discuss a little bit further about tax loss harvesting, which is something we discussed with Wealthfront. They handle it automatically for you, but I believe it's also essential to understand what's going on. Overall, this is a capital gains tax method in which you sell shares at a loss to balance a capital gains tax obligation, which is normally done at the end of the year. So let's assume it's December and you realize, yeah, I sold a few stocks and earned a lot of money. However, there is this particular stock I have that is actually down by a lot. What you're aiming for is to sell the stock for a loss, and that loss will be used to balance any profits from that year. Then you'll replace it with a similar asset to balance your portfolio. However, before doing so, you should be aware of the wash sale rule, which states that you are unable to buy back a stock for 30 days if you declare the loss for tax purposes. So this is essential, because disobeying or ignoring it can result in serious penalties. To illustrate tax loss harvesting, suppose you acquired stock at a low price and gained $50,000 in gains after 3 months of holding, and now you wish to sell it, meaning your total earnings thus far are $50,000 in short-term capital gains. Assuming a 37% tax rate, so you'll pay $18,500 in taxes, without adding any relevant estate taxes. You also purchased stock B at the same time, incurring a $25,000 loss after 3 months. Now that you want to sell it, your total loss on this stock is expected to be $25,000 in short-term capital loss. And we'll have our $50,000 in short-term capital gains and deduct the $25,000 in short-term capital loss to get a $25,000 net short-term capital gain, which will result in $9,250 in taxes. You'll notice that by doing tax loss harvesting in this example reduces your tax payable by half. The same also applies to long-term capital gains, but they must be offset in the same way, so you can either offset long-term capital gains with long-term capital losses or short-term capital gains with short-term capital losses. Overall, if you intend to sell an asset for a profit, this is an excellent approach to save money on taxes. Let me know in the comments if you have any other questions about investing. Let's return to the video. So we've discussed a lot of different things, yet what would Warren Buffett do? Warren Buffett is known as one of the world's most successful investors, and these are the criteria he looks for before investing in a company. First, he searches for a company with strong leadership because he understands that executives can build or destroy a company. He also seeks for stocks with such a margin of safety and companies that will be there for a long time. He values solid company fundamentals, any competitive advantage called a moat, and he also believes that if you aren't willing to buy a stock for 10 years, don't even consider owning it for 10 minutes. Obviously, he's a long-term investor who loves the long game, which is why he's been so successful. Warren Buffett believes that for 95% of people, an index fund that records such as the S&P 500 will be ideal for creating long-term wealth. Example, most people will make more money by simply buying something like Vanguard 500 and allowing it to sit for decades rather than actively buying and picking different individual companies. He also states that you must buy after conducting extensive study, so you must truly understand the company as well as its sector. Thus, he does not invest in any companies which he is unfamiliar with. He's also powerful in looking for excellent investment possibilities and undervalued companies. Overall, he invests with facts rather than emotions, which you will soon learn is critical. We were going to discuss two major investment techniques: value investing versus momentum investing. So with the value investment strategy, you buy companies with lower PE ratios. You're more concerned about fundamental analysis, so as I said, the price to book ratio, the PEG ratio, and so on. You care so much about purchasing undervalued companies that may be kept long term or until the company will become overvalued. Whenever stock prices are volatile, value strategies remain relatively steady. On the other side, you have the momentum investing, which is when you are primarily concerned with a company's future potential. So frequently with these sorts of companies, such as Tesla, you see extremely high PE ratios, and fundamental research does not matter as much. And these investments seem to be more dangerous and volatile. Company debt is also seen favorably as a source of future growth, and momentum methods reward when stock prices continue in a similar direction. What you can do is combine these two approaches to balance out long-term performance while managing risk using the value investment strategy. You know you'll have more consistent gain over the long run since prices are more stable, but the growth may be less than when you utilize a momentum investment technique. However, I do not believe that one or the other is superior. Instead, I propose using both of these methods. Now, I'd like to highlight the significance of investing early. The sooner you invest, the more compound interest and exponential growth you will get. You see exponential growth if you invest in markets versus linear growth if you invest in savings account or cash. Once you invest in stocks and let them grow over time, you will be substantially richer in the long run. It's just not even close to exponential growth. Therefore, if you want to retire wealthy or have your money work for you, then you should invest in securities like stocks so that the idea that you have money may really generate you more money. This is why the wealthy get richer and have such a huge advantage in regards to accumulating money. Now here are my thoughts on how you should invest. I'll suggest that you should never invest more than what you can afford to lose track of your primary goal of increasing your income. So the more money you make, the more money you have to invest. This may seem basic, but many individuals overlook income production, which is perhaps the most important factor. The more money you make, the more money you'll have after paying your obligations, and all of that money can be invested. Assume you have someone earning $35,000 and someone earning $150,000. Assume they each have $20,000 in annual costs. The first individual has an extra $15,000 to invest, but the second person has an extra $130,000 to invest. There is a tremendous difference, which is why it is critical to focus on increasing your revenue. Since you're young and have extra money, you should absolutely consider creating an account after seeing this video, because information without action is fairly meaningless. Generally speaking, invest early to take benefit of compound interest, and also think investing in things with a higher ROI. There are so many various things you can invest in that aren't just stocks, such as starting a business, self-improvement education courses, or marketing, and many of these may have higher ROI than stocks. So I recommend doing a variety of these. Do not invest all of your money in stocks. Set a monthly target for how much money you want to invest depending on your salary, like I mentioned. Prioritize index funds. Index funds make investing simple, allowing you to devote more of your time and efforts to growing your income rather than worrying about which firms to invest in and when to purchase and sell. That's why I'm a huge supporter of buy it, set it, and forget it. Of course, if you want to save more money, start budgeting, since the more you budget, the less money you'll waste, and the more money you'll have to invest in assets such as stocks. I must highlight the need for due diligence once more. Conduct your own study before investing in anything, particularly stocks. My golden rule is that you should spend at least 1 hour researching everything you want to invest in. And if you are unwilling to spend any time researching, utilize something like Wealthfront, since they'll do all the work for you. Discover what type of investor you are. Consider your risk tolerance. Consider your timetable and how much time you want to commit to studying several companies. The app brokers you use provide the initial step of due diligence. Use something like Webull, Moomoo, or Wealthfront instead. And the second level of due diligence derives from your own research as an investor. So far, we've looked at the basic and technical components of these companies. I realize this topic was quite long in many parts, and we covered a lot of ground. Yet there is still a lot more you can know on investing. So if you want to do further study, here are 3 books that I highly suggest. The Intelligent Investor by Benjamin Graham is a classic that practically every investor reads. The Investing Quick Start Guide, which is a really actionable investment guide. And Warren Buffett's Interpretation of Financial Statements. This book will shift your perception of what you should be searching for in a valuable item. To conclude the video, I'd like to emphasize that all of this knowledge is meaningless without action, and thus, these are the concrete steps you must be implementing right now. Make your money work for you. So I sincerely appreciate all of your time spent with me. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.